And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is the Hump Day edition. That means Danny Ratliff will be joining me this morning talking about you can't retire. Just forget about it. It's not even worth it. But we'll get into that this morning. A couple of interesting things, of course. We'll get into the CPI report here in just a second, talk about the market's reaction, all those type of things. But, again, what was interesting here over the last really kind of 24 hours is that we've been talking about this need for a correction, and, that came pretty fast and furious yesterday. But most importantly, I would be remiss if I didn't remind you again this morning, today is Valentine's Day. Do not use Google search. Did you see my tweet this morning?
No.
Okay, you didn't?
No.
Okay, so...
One of many, I'm sure.
Well, I put out a few this morning on Twitter, but on Twitter this morning, I put out a picture of the United States, and it had the most searched Valentine's Day items by every state on Google. Do not use Google to search for advertising because in Texas, it's plus-size lingerie.
Really?
Yeah. They say everything's bigger in Texas. I advise, it's like, look, there's several things you don't buy your spouse on Christmas, birthdays, or Valentine's Day. Anything related to housework, workout, diet gear, or clothes. Never buy your wife clothes. If you get the size wrong, you're toast. So just keep it
hang
simple.
on to the receipt.
Kroger's, parking lot, HEB, they have all the accoutrements you need. Flowers, get you taken care of, but don't forget today is Valentine's Day. And it
was nice knowing you.
Right, yeah. And my wife, she went above and beyond.
Yeah.
Right? She made reservations for us at a very nice restaurant tonight at 6:30.
Nice.
Who eats dinner at 6:30 at my age?
Yeah, no kidding. It's a little late for you.
I know, right? I mean, I've got to be in bed by 8:30, 9 o'clock. I mean, So I told her this morning, I was like, 6:30, really? But anyway, so I will be probably a little bit sleepy in the morning.
Little food coma hangover tomorrow.
Little food coma hangover in the morning. But anyway, look, happy Valentine's Day to everybody. I hope you enjoy it. Have a great day. All right, so a couple of things, like I said this morning. Let's talk a little bit about CPI yesterday. So CPI came in a little bit hotter than expected yesterday, and of course that kind of shocked the markets a bit. Yields popped up. We had talked about Treasury yields had gotten very, very overbought back in that kind of when yields fell from over 5%ish, below 4%. That rundown in the last part of last year got yields to be very overbought. We've been talking about this kind of correction that we needed in yields to have another buying opportunity to add to fixed income. We got that yesterday. That jump in yields got us back up to our target range, 4.25, 4.5. So somewhere in there is going to be a good position to start buying bonds. And again, we'll talk about this more in the newsletter this weekend. But there's a correlation between interest rates, inflation, and economic growth, and those are all centering around 3% right now. So bonds are undervalued relative to where we're going to be on inflation and economic growth later this year. But beyond that, the issue with inflation yesterday was a bit of an anomaly. It was primarily housed. There were some things that ticked up over the last month, medical services, those type of things, but those are much smaller components of the overall CPI index. The big jump came in homeowners equivalent rent. That's about 40%-ish of the overall calculation of CPI. There's a big divergence between homeowners equivalent rent, which is in theory, it's a survey that says, Brent, what do you think that you could rent if you live in your house right now? So I'm a homeowner, right? So Brent's a homeowner. So in theory, it's a survey that says, Brent, what do you think you could rent your house for right now, if you were to rent your house? Well, look, everything's doing great right now. The markets are up, the economy's great, we're having just, a massive exuberance, and so everybody feels better about things. So that survey comes back, it's like, well, I can rent it for this. So we saw a big uptick in homeowners equivalent rent, but actual rents of residences is declining. So there's a big divergence. Now, that can happen, but we've never had one this big kind of on record since like 1990s, right? It's been a very big divergence. That's going to reverse itself probably in the next month or so. That'll get corrected. So again, a bit of an anomaly yesterday that kind of spooked the markets across the board. And here's what you need to know before the bell this morning. So that we've been talking about for the last several days that we were due for a correction. Now, again, as we said, corrections aren't crashes, right? We don't have to worry about that. But we got a correction right down to the 20-day moving average yesterday, bounced off of that right in the close. We had a little bit of buying coming in right at the close yesterday, so that was good. This morning, futures are pointing higher. So again, these corrections and this bullish trend continue to be very, very short-lived. So it doesn't give you a lot of opportunity to put capital to work. But we did get that. We did work off some of that overbought condition. Now, the only risk is we're very close to triggering a sell signal again at a fairly high level. So again, a bounce that now fails below the recent high, turns lower, takes out the 20-day moving average. That's going to be your signal that we're in for a bigger correction. If the markets can recover, go to new highs, then this bullish trend is still intact, so not much to worry about. So again, the point here is not to panic over anything. Yesterday was a much needed correction. We've talked about that for a while. You're going to get one. Corrections tend to be very short-lived. This is very similar to what we saw back in kind of late January. We had that very same similar kind of drop in the markets following the FOMC meeting, and then next day rallied right back up and took off again. So again, that's kind of the point of where we are right now. This is a very similar setup to what we saw back at the FOMC meeting. And so if we start to see this market turn back up today, right now implied open on the S&P is up about 28 points. So that's not going to recover what we lost yesterday, but it's a good start. If we can get back to a new high, that keeps this bullish trend intact for now, just keeps you long equity. So again, nothing to really worry about. If we do fail and then take out that 20-day moving average, then we're going to start talking about the 50-day moving average, potentially retracement back down lower. We have a very big deviation right now between the S&P itself and this 200-day moving average. So this deviation is one of the larger that we've had on record as of late. I don't know why my screen is not working this morning. But this deviation is very large. In fact, we have to go back for a good bit here to see a relative deviation of this magnitude, and that was just before that July correction that we had last year. So again, these deviations from the 200-day moving average, they can exist, but the problem is when you have such a big deviation from these longer-term moving averages, you're going to get a correction at some point. And that's what I'm saying is that later this year, we're likely going to see a correction that is somewhere between 5 and 10%, somewhere along the way. And that'll be that reversal. Now, that's not likely going to be today or tomorrow or next week, but again, that is coming. As long as we can maintain this bullish trajectory, that's fine. But we are very long in the tooth on this trend, and the internal breadth of the market, the number of stocks above their 10, their 20, their 50, their 100, 200-day moving averages are continuing to decline. So we have this negative divergence between stocks participating in this rally and the actual market itself. And those typically tend to be unsustainable and typically lead to bigger corrections. So again, while we're still in this bullish trend, everything is fine, but we are at a point that we are going to get a bigger correction at some point over the next few months. So just something to think about. That's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff on the other side of the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome to the show this morning. St. Valentine. Of course, I was saying that Valentine's Day is today. Danny, if you, I know you probably can't say what you've done so far because Michelle's probably just getting up and going this morning. So, but have you prepared for Valentine's Day today?
No.
Not at all?
No.
Okay, Kroger's your best friend.
No. We have a deal.
Right.
And, you know Michelle well enough. You know
yes,
she's
I know her very
very
well.
sensible.
Yeah.
And we don't celebrate Valentine's Day.
Oh, so you were joining the thousands upon thousands of other young millennials that are now tuning out of social media on Valentine's Day in an act of self-love.
I feel like they're joining me. We've been doing this for a long time. So, no, but you know, you kind of look at and you say, this is crazy. I mean, I'm going to go buy flowers that I can buy for $10 any other day of the week for $100-something. Sure. No way. So
got to support the economy.
We have a deal though. I mean, she gets flowers often, but like we don't go nuts.
Right.
And I'm not going to go buy her a bear or chocolates or something that she really doesn't want and need. And so no, we don't. Now we will with the kids a little bit. You know, like she does small things for them. And she allows, you know, they do stuff at school and we make it fun for them. But for the two of us, I mean.
Yeah. Can I insert a disclaimer here? Because if you're listening to Danny right now, this is an agreement they've had that they
this
verbally,
is an agreement. Yes.
This is an agreement. I highly advise you not to go home today and try to invoke this on your wife. Honey, we're not going to celebrate Valentine's Day today.
I think this was written into their vows.
Yeah, I'm pretty sure.
We have some we have some pretty good
I think the agreement as well. And my wife and I are the same way. We really don't do anything on Valentine's Day other than go on a date. That's our thing. We go on a date together.
We will cook with the kids is what we do.
Yeah.
And so let them like typically they cook, they can serve, they think it's fun, right? Yeah. But we don't. I'm not going to go spend a bunch of money at a restaurant and deal with the mess and the crowds and everything else. So
don't disagree. So Brent always puts little notes on my my note screen in the morning, and this one was roses are red, violets are blue. St. Valentine. I was beaten with clubs, beheaded, buried under the cover of darkness, disinterred by my followers, and you commemorate my martyrdom by sending each other chocolates. So there's Brent.
It's the day of love.
Yes, there's Brent's 2 cents on the day of love.
So, gentlemen, if you're given a hard time, Brent, you need to post that link so somebody else can use that in their defense. Like, hey, you really don't want to celebrate this day?
Yeah. And as I was saying, I put on on Twitter this morning, do not search Google for gift ideas.
Oh, is it bad?
Oh, yeah. It's like in Texas, plus size lingerie. Highly advise you not do that.
Plus size
That's the biggest Google search in Texas.
Yeah, in Texas, plus size lingerie.
For Valentine's.
Yeah.
So people are asking for that. Or looking for
They're
that.
looking for
for
it.
that.
Wow.
They're looking to be suicided is what they're looking for.
Look at
Yeah,
Conundrum
right.
in all the wrong places.
Whatever you do, if you're buying that kind of stuff, make sure you go too small.
Exactly.
Oh, honey,
Should
I don't
be-
know. That's weird. But these things must have shrunk.
Always go small.
I could have sworn you were a size 4.
Exactly.
Oh, man.
Always.
No, but you see so many people. I watch the kids; they get a kick out of it, and they're having fun with friends. But man, just what a racket!
Yeah. No, it is. It is. All right.
Thank you, Hallmark.
We have. Yeah, but it is interesting. A lot of kids are going. They're kind of ghosting Valentine's, right? So they're getting off social media
Yeah.
for the day. They're just staying out of it altogether. So.
Listen, I don't think love is a bad thing or showing somebody that you care for them. I think that's fantastic. I think though we should be doing that all the time and not just one day of the year.
365.
Yeah.
Yeah.
Correct.
Yeah, relationships will be much better if you do that. Acts of love are easy. Okay, so let's talk about retiring. It's interesting. Older investors think they're ready to retire. Advisors disagree. And it's kind of an interesting article because I wrote an article last Friday. It's on the website. So and we actually went through this on the show, but if you go to the website, it's called Older Investors Are Piling into Equities. Is it a good idea? And what we're seeing is a lot of equities, a lot of individuals, they're approaching retirement and they're putting a tremendous amount of money into equities to try to play catch up for retirement. And Brett, can you share this chart for me? This was a chart that we showed in that article. And this was these surveys are out. Danny and I go through these surveys with you all the time, but this was a survey that was out on CNBC. And they ask, adults from their 20s into their 70s, how much do you think you need to save up for retirement? And so, 20-year-olds are saying, I need 1.2 million for retirement, and 30s are 1.4. The average was 1.6 million that people needed for retirement. And that's what they thought they would need to have saved up. The problem is that even people in their 70s who've had an entire life to save up their money only had about $113,000 saved up, and they need $950,000 for retirement. So the problem is always the case. And I was actually doing a podcast yesterday, and this was the question, about saving up for retirement and those type of things is that we have the best of intentions, and but when you're in your 20s, Danny will remember this, right? I remember being in my 20s, but when you're in your 20s and even in your early 30s, you're barely making ends meet. You're just making enough money, and of course, you talk about inflation and things today. It's even tougher, but you're just barely making ends meet. You don't have a lot of extra cash flow to be socking into investments. And then you get married, you have kids, you've got a house, you've got school, you've got all this other stuff going on. You're still not, and you got to pay for college, whatever you're going to do. So you're still not saving money. So for most people, and we do seminars all the time. We do different types of events, and I always ask people. I always say, so how old are you now? On average, and by large, by the time you get interested in money, you're probably in your 40s. Most people don't get serious about saving until they're in their 50s. So if you're going to retire at 65, you've got like 15 years to get this whole thing done. And so, the important part about this is understanding valuations when you start, because if you start a 15-year life cycle to save for retirement, you better be in a period where you have the potential to grow assets. And a good example of this is, if you were 45 years old in 1999, by the time you actually made any money in the market, you were near 60. Because that's how long it took for the S&P to go from where it was in 2000 and to finally break above that level again in 2015 on a nominal basis. So,
well, that's assuming that somebody wasn't continuously putting money in, right? Somebody at 45 would have used that to their advantage as well, because they were likely contributing, getting matching contributions to their 401k, putting funds in other areas. So that volatility can be your friend.
It can be, right, if people actually did that. But again, when you go look at the average savings in 401k plans, if you look at the average balances in 401ks, look at the average investment saved up by individuals.
It's awful.
It's terrible, right? Which just goes to tell you that when you go through a secular bear market like we saw in the .com crash, people got out of the market. They never came back. They were like, I'm done. I lost half my money in my 401k. Screw that. I'm not doing that anymore. After the financial crisis, Danny, how many people do you have come to you that are still not in the market?
Oh, a ton. I mean, all the way until a couple of years ago. I mean, we don't get those calls as much anymore, but we were getting a ton of those calls saying, hey, I got out. I've been a terrible investor. I never got back in. Sold at the bottom or sold before. But that's the key, right? So many people want to know. They're like, oh, well, you guys need to be able to hit, we need to be able to get out everything out at the right time and get right back in at the right time. But I've never met anybody who's done exactly that.
Right.
I know a lot of people who got out before, or most people who got out after, and then never got back in.
Exactly. And Danny, to Danny's point, he's absolutely right. These long secular bear market periods like early 2000 are great opportunities to make money. And you can do very well, and people did very well, but on average, most people didn't. And the stats prove that, right? If you're 70 years old, right, and that means you went through the entire bull market of the 80s and the 90s, which was 15% annualized. You went through the dot-com crash. Then you had the rally from 2002 to 2007, so you had another big bull market. And then you've had the biggest bull market on record going from 2009 to present, and you only have $113,000 saved up. That's the problem.
Well, there's a couple of problems with that. Number one, a lot of people, once we see any type of significant volatility or we get into a recessionary period, what do? We stop contributing.
All right.
Right? So number one, you've probably moved the portfolio and said, hey, you know what? I can't take anymore. This has been my livelihood. I've got all the funds I have saved. And it's human nature. I get it. It's flight or fight. Most people flight.
Right.
They say, screw it. We're going to sell it. We're getting out. We're moving.
Right.
And the problem is then we stop our contributions to any type of investments or plans, and we wait. What do we wait for? We wait for things to feel better.
Right.
Well, when do things feel better? When the economy's improved, when the market's improved. And so what at this point are we doing? Now we're buying into a much, higher market. Now, granted, I'm not saying throw everything in, but I think this is an important lesson in the sense of you want to have some cash at different times, especially in times when there could be some volatility in the horizon. But the other thing is that just in general, when we stop those contributions, I mean, I can't tell you how many people I've talked to, and they're like, hey, I'm not going to contribute. This market's terrible. I'm like, no. This is we really want to make sure you're maxing those things out.
And what this all comes down to is all about psychology.
Yeah.
Right. As investors, we do everything backwards. We should be buying when things are terrible. We should be selling when things are great. Look, everything's great right now.
Well, it goes against human nature.
Well, it does. And right now it's a greed factor, right? Markets are at 5,000. I got to get in. I'm missing out. And again, this was the interesting thing about our business is that, until, going back a couple of years, people were showing up going, I've been out of the market for a decade and this market just keeps going up. I've got to get in now.
Yeah.
Really? Now we're back to the second highest levels of valuation in history and you want to get in now? That's the challenge. So the point is, and look, as investors and as individuals, we've really got to be aware of our psychology and making mistakes. But, this was the setup. I want to come back and talk about this article about older investors think that they're ready to retire. And a lot of advisors disagree, and we'll explain to you why. Well, part of it is not enough money, but we'll come back and talk about the rest of it with Danny right after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my wife, is trying to get her house remodeled. It's been a standstill ever since late December. Like, nothing's been done. So I've been emailing the contractor saying, hey, what's up? What's up? And he's not emailing me back.
The Real Investment Show podcast.
So I emailed him. I said, I would advise you to give me an update as to what's going on because I'm going to refer this to my wife and you don't want to know that. And he didn't respond to me. So
if we don't get something
unleash
by
the
3 o'clock
Kraken
today, if you're listening.
Same show, your schedule.
Guess what? We had a response by the afternoon.
Oh, yeah.
And everything is now back on track and will be completed on time by the deadline.
At realinvestmentadvice.com.
That's FAFO, man. Don't make me unleash my wife on you.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. All right, so older investors think they're ready to retire. Advisors disagree, and of course advisors disagree. That's our job. I'm never going to tell you the truth. No, I'm just teasing.
Whoa.
No, I'm just joking.
And this is
I'm
why
just joking.
Lance does not do financial plans.
No, it is an interesting kind of a study. Financial advisors have significantly different perceptions of their clients' retirement readiness than do the clients themselves. That's not really surprising, though. I mean, I run into, a lot of people, they live on $10,000 or $15,000 a month, whatever it is. And they go, well, yeah, but when I retire, I can retire on $2,500 a month. I was like, no, you're not. You're never.
No, that's not happening.
And I'm looking at the wife in the background, and she's like, it's like, oh, we're just, we're going to cut everything down. We're not going to travel. I was like, no, that's not going to work. But that's kind of part of it. And this is why financial planning is such an important thing, is to, put together realistic perspectives. And personally, I even disagree with a lot of financial planning that says you'll live on 80% of your income in retirement. When I do my personal financial planning, I'm at 110% of my earned income because I want to make sure there's a buffer because of higher medical costs. My wife's going to want to travel more, whatever it is. So, I start looking, I kind of ramp things up, and I exclude Social Security when I do my own analysis.
Yeah.
Because if I get Social Security, great, that's a bonus. But if I can make sure that I'm prepared financially on my own, then everything else is gravy.
Oh, man.
Right? So
I can't wait for all the conversations later today about Social Security.
I don't know. No, this is just me. This is the way I do it, right? So don't get on Danny.
And he
about
still
this.
can't retire, folks. I mean, look at this.
Yeah.
So hey, so I get everything that you're saying. I think that's really smart. You need to look at it many different ways.
Right.
But I think going back to the survey, and going back to your chart a bit ago.
Yeah.
I think people see these big numbers and it's so intimidating. right? People see this big number, they're like, oh my gosh, how am I supposed to ever save that? I can't even save, $100 a month.
Right.
I'm just trying to make ends meet.
This is why we see so many people speculating in the markets, trying to make up the difference.
Well, that's right. They try to make that up. They make up for lost time, trying to become more aggressive than what they likely should. And I think that's really problematic as well. But this survey was from Allspring Global Investments Annual Retirement Survey. They said nearly 2/3 of retirees and near retirees consider themselves ready for retirement, but yet 40% of advisors said their clients weren't ready. And this is kind of interesting, I think.
No. According to this, it says 40% of the advisors said the clients were ready, so 60% said they weren't.
There you go.
Right?
Yeah.
So am I reading that correctly?
No, you read that right.
Okay.
It's just an interesting way for them to put that. So if you have 60% of those advisors saying they're not ready, now, number one, how well do they know their clients?
Right.
Number two, they're basing this off of simple stuff. And I say simple, I only say simple because this stuff we do every day. And most people are not probably prepared to or understand Social Security, Medicare, small things like that as well as they should. And that's why we're employed and we do what we do. Now, there's many also, I think, advisors who don't know that either. Mm-hmm. I think there's a lot of really, really very talented, extremely smart advisors out there. But there's also a whole lot that are salesmen and that don't understand Medicare, that don't understand Social Security, that don't understand taxes, that don't understand how all of these things fit together. And so if they don't understand it, I'm not real sure how they're going to be able to feel like somebody else does. And granted, I would say that there's a lot of people that don't know these things well enough. There's not enough education surrounding it. There's not enough advisors that talk about it on a regular basis. So I think that's really difficult. It's maybe a little bit unfair statement. Would you agree?
Yeah, I agree.
I mean, and I think, some of we do, you mentioned webinars, seminars that we do. Some of our most attended webinars are Medicare, Social Security. I mean, basic stuff, not about the investments, but about the, how do I file? How do I do this? How do I keep more money in my pocket? And I think that's only going to become more prevalent as, things change. We potentially revert back to the old tax code. But, they interviewed 1,515 people. The sample comprised of 752 near retirees, so average age of 61, 763 retirees, average age of 70, and 320 advisors with at least $5 million in assets under management. So if you're interviewing also, my other thought, Lance, is that if you're interviewing somebody that's managing $5 million, now this is the bottom, they have to have at least $5 million. They're either very young in the business, so they may not know it, or they don't have a lot of experience, or just haven't been able to grow their business well. So they may not know the things they need to know.
Right. And I thought that was interesting, actually, because if you, I'm actually looking at the survey right now. Here, Brent, let me move this over here real quick, because there was kind of some interesting information on this, and I thought this was really kind of interesting, which is this section on, Brent, this section on with the six little dots. This is a section on Social Security, Medicare, and Medicaid, and it's what advisors think that their clients know about Social Security, Medicaid, and Medicare, which I think is interesting, because we do see a lot of individuals that are approaching retirement that make mistakes with Social Security distributions when they claim Social Security, the spousal claims, those type of things. And what this thing is saying is that people that are near retirement or retirees think they know a whole lot more about the ins and outs of Social Security, Medicare, and financial planning than probably what they actually do.
Yeah, no, I think that's absolutely right. I think a lot of times we take advice from neighbors. We talk to people, right? We're at a dinner party. You talk to somebody and say, "Oh, hey, did you take Social Security yet? Oh man, you've got to take it now. It's going to be bankrupt, or you got to get every dollar you can out of it." When you take it early, you're likely not going to be doing that. And so I think that where we get our information from is also important, and not just in understanding that what may be good for one person may not be good for you, especially if you have longevity. I mean, there's so many things we can go into with each one of these specific topics, Lance. Mm-hmm. But I think, it's kind of interesting. Like 6 in 10 near retirees know that their 401k or 403b plan offers advisory services through the plan. 47% of near retirees are equally likely to work with the advisor associated with their plans as with any other advisor. I think that's just easy, right? So that's what most people will do. But 1 in 20 retirees continue to work part-time, most by choice.
Yeah.
And most people retire sooner than they expected. Well, 37% retired sooner than expected. Only 6% retired later than expected. So we find this often that somebody says, hey, here's my target date. Here's when I'm going to retire. I'm going to retire at 62. I'm going to retire at 65. And it is often well before that because of something that happens in the family. Maybe a death, that may be an illness. You're taking care of a parent, a loved one. I mean, we see that as one of the most frequently things that happens where somebody does have to retire earlier.
Yeah, the whole problem with the sandwich generation is becoming much more prevalent now.
It is.
As parents are living longer, kids are living at home, parents are stuck in the middle taking care of both.
We have clients that are doing exactly that right now. They have a parent at home. They've got a child back at home, maybe grandkids in the house as well. I mean, you're talking about multiple generations in one house, which used to see a lot more of that. Yeah. And I think you're probably going to see more of it as we, if you look at those numbers you showed from your article on Friday. I mean, if people aren't prepared, how are you going to do this?
Well, I know. And that's why when my kids went to college, I took their house keys away.
Good for you. Hey, my dad said when I graduated, he said, I don't care where you go.
Just not
You
back
just can't come here.
Exactly.
And looking back, I was like, what? I was like, this is crazy. I was thinking about like my buddies who were saving money back at their parents' house. But I'm extremely grateful for it because it made me understand things pretty quickly. And I felt like I had a pretty good understanding already. But he's like, no, that's not going to happen.
It's not an option. It's not an option in our house either. I do think it's interesting, though, and again, when you start talking about, we have very different ideas about retirement. Mm-hmm. And, like for me personally, I will never stop working simply because I can't imagine sitting around the house. I can go play golf, but I mean, how much golf are you going to play? Right. I mean, after a while, I remember a story of my dad. So my dad worked for Dow Chemical for 30 years and he retired from Dow Chemical and he had been retired for about 3 months. And one day I called him and said, hey Dad, just calling to check up on you, how you're doing. And he said, I was standing here this morning looking out the window and decided to go back to work. And I go, well, why are you going back to work? He says, well, there was a stapler on the table. I was thinking about stapling my ear to my head, and I figured that was about time to go back to work. And it's just, my dad loved to fish, and he was going fishing every day. And it was great. It got boring after a while because he was by himself going fishing, doing his thing. And it was like, I need to go be around people. I need to do things. And there is studies out that show that remaining active and in work of some sort, and again, it doesn't have to be a 9-to-5 job. It can be part-time, but being around other people, socializing, being mentally active helps you have a more healthy, structured retirement, and people tend to live happy. Their happiness tends to be higher than those that have retired and are just sitting around the house all day.
Yeah, I think there's a lot of truth in that. I mean, we do find, in fact, that people that retire early and they're not social, they don't find that purpose, Lance, that they actually, their mortality rates are much higher.
Right.
Just, you're sedentary, number one. There's only so much TV or things that you can do. And if you don't have some type of built-in network, that can become a bigger issue. Yeah. So yeah, I could see that. And I can see where we have a lot of people who, if they don't find a way to plug in somewhere, retirement's not what they thought it was going to be.
Yeah. I'm thinking I'm going to just be a barista at some point.
I can envision that. Hey, here's a chart on your...
Exactly. I'm gonna be a barista that hands out economic and investing advice to young coffee drinkers.
Hey man, it's your new YouTube channel.
Exactly. It may be an idea. Yeah. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. Getting ready to wrap up the show as futures are pointing, decently higher this morning, as I talked about earlier. When you're in a roaring bull market like we are right now, where you have a lot of sentiment, a lot of fear of missing out, those type of things, pullbacks are very short-lived. And yesterday was a good example of that. Very nice pullback yesterday, right to the 20-day moving average. Bounced off of it right at the close yesterday. Technically, everything is still intact at this point. Markets are pointing nicely higher this morning. So, one-day shock on the CPI report. And again, not surprisingly, people kind of saw through that CPI report yesterday, saw that it was an anomaly in housing that gave you that inflation spike. And so that'll all get worked itself out. And so markets already kind of working through that process. So, again, if you actually take a look at CPI itself, we're still at the lowest level in 2.5 years, and it's declined a lot from a year earlier. It's just going to get a little bit more difficult to go from 3% to 2% inflation than it did getting from 9% to 3%. So it's just a function of year-over-year comparisons, and that's just going to be a little bit more challenging now, because instead of comparing this time last year where inflation was up 1.5% in a month, now we're talking about the last time this year, inflation was 0.2 versus 0.1. So those very small incremental changes are going to make it more difficult and not impossible at all. And we'll get towards 2% eventually, but it's just going to take a lot longer to get there because we're talking about much smaller incremental changes in the rate of inflation over time.
So when you're talking about much longer, are you talking 6 months? Are you talking a year, 2 years?
2 years.
Yeah.
Yeah.
So this is stickier than what most people anticipate. Like you anticipate getting stuck in this 3% range for a while, like we had been.
Yeah. No, it's going to be, we're not going to be stuck here at 3. It's going to be 3, 2.9, 2.8, 2.9, 2.8, 2.7, 2.8, 2.9. It's just going to be back and forth for a while. And it's just going to be kind of a much slower grind lower, kind of a normal, what you would expect to see kind of in a normal slowing economic environment, because the economy is going to slow. So the economy will slow back towards 2% as all this stimulus spending is out and the Infrastructure Act is out and the CHIPS Act, rolls its way through. There's a lot of CHIPS money that still haven't even hit the market yet. I was actually having a conversation yesterday on this podcast I was doing. She had just been to California, and there's a lot of companies out there that are basically, you put together a PowerPoint, you send it to the government, say, hey, we're going to build chips, they'll give you money. And these companies are not generating revenue, but they're getting money from the government through the CHIPS Act to build chips that will probably never get sold anywhere. But that's just the games that you can play with and that's the problem with all these government spending bills that we do. It's like, oh, we're going to do an infrastructure act. And so everybody just submits proposals, they get money, and the stuff never gets built or gets halfway built, whatever. But that's the problem, that we don't have better oversight on these bills and the money that we spend. We throw out billions of dollars. We don't even think, if it's $1 billion, we used to be concerned about millions. Now billions are like left pocket change, right? We only get concerned about the $1 trillion bills. But it's just getting ridiculous. But we spend so much money on things we have no control over. And there's so much waste and fraud and everything else. And we're going to find out in a couple of years, just like with remember the whole PPP programs, the payroll protection programs that we had?
How many people took advantage of it?
Yeah, billions of dollars of fraud in that. So again, it's just, even in the stimulus checks, billions of dollars of stimulus checks were fraudulently taken by people that were just claiming benefits. But again, this is what happens because these things are thrown together in a rush. There's no oversight and there's no follow through. So,
well, I think that's what made managing money difficult as well. Like on the YouTube channel just a bit ago, somebody's asked, like, well, what about long duration bonds?
Yep.
And how do you manage that? I mean, the anticipation, the market was saying, hey, we're going to have 5 or 6 cuts. We're going to start in March. Now I think they went down. CME FedWatch just this morning or yesterday, was it like 10% versus like 86%?
Yeah.
It was like 50%. Then all of a sudden it shot way, way up. And then all of a sudden it's been dropping like a rock.
Yeah.
And so now they're saying it's going to be June or probably even more likely. I think the Fed is indicating more like July, August, right?
Yeah,
Third quarter.
Yeah, I think honestly, I don't think it's going to be till this is my opinion, right? But I don't think the Fed's going to cut rates. If they cut rates this year, it won't be until the second half of the year.
Yeah.
So,
well, and I think this is it's a conundrum because everybody's anticipating that, okay, they go and they cut rates quickly, but why? What's the incentive here? And if they're doing so, that means that there's got to be some devastation in the economy.
Well, that's what you would think. And this has been the interesting conundrum, right? And so just set everything aside for a moment, right? So why does the Fed cut rates? The Fed cuts rates to offset recessionary pressures in the economy, okay? So for years, we were stuck at zero. So the Fed had no ammo to offset any type of recessionary drop because they can't go negative. They can go to zero, but that's as far as they can go. Well, now you're at 5.5%, and you've got plenty of ammo in the gun to cut rates. So if everything, and this is my opinion, so if I'm Fed Powell, I'm sitting there going, I'm not going to cut rates. Y'all are, look, the economy's fine. We're rolling 3% a quarter right now on the economy. There's no credit stress in the markets. Yeah, regional banks are having a little bit of issues with commercial real estate. We can bail that out. We'll just give them another program. But there's really no reason to be cutting rates at this juncture. Let rates sit where they are, because if you let rates sit where they are, the housing market will continue to come down, which will make home affordability better. We did an article on this last Friday. If you leave rates where they are, it is going to slow economic activity, which will pull some of that excess demand out of the market and get things back more towards a normal. It'll bring inflation down, right? Back down towards that 2% level. And then once you get down to that level where things are starting to get where you want them, then you can say, okay, let's pull some of that tightness out of the market, right? Let's ease the brake a little bit here. Let the housing market kind of recover a bit, let things stabilize. But again, even at that point, you still leave rates at 2.5% or 3%.
Yeah. Well, this is what's been so difficult too, because every time that, in the past so many months or years that there's been an issue, there's just been more stimulus.
Right.
And so that's the other thing that you have to fight, right? So we're combating the Fed's behavior, but also them trying to execute a soft landing, which obviously is pretty difficult. But
that's why
they already overshot?
Well, no, look, that's why the Fed's going to cut rates. Despite the fact that, as I said, there's really no reason to cut rates, they're going to cut rates to offset any type of risk in the markets. They're trying to get ahead. They were behind the whole inflation curve, right? Now they want to get ahead of the disinflation curve. And they're going to try to get in there before there's a bank crisis, before there's any type of event. So that's the reason the Fed's going to start cutting rates. They want to ease monetary policy to try to get ahead of whatever tight monetary policy would have created, which, i.e., would be a recession. So they're trying to get ahead of it and keep the economy out of a recession by cutting rates sooner.
Yeah.
Yeah.
No, that makes sense.
Which is not a great idea because, look, we're so scared of a recession, right? But recessions are good, right? We need recessions. They provide a lot of benefits. And look, people can't afford a house, right? A recession will cure some of that. It won't cure all of it.
Yeah.
But recessions are a good thing. Yes, they're painful, but the reason we have the financial problems we have is largely because we keep trying to avoid having these recessionary periods where you reset the excesses that occur in the markets.
Well, that's the issue. I mean, it appears the Fed has tried to take a recession out of the business cycle.
Mm-hmm.
And at some point, you just make it worse.
Correct. Yeah. The eventual reversion to the mean gets more brutal when you delay that reversion longer than you should.
You know, this is an interesting deal, you know, in general, right? So they're trying to avoid a recession, but yet for them to cut interest rates, they want job numbers to deteriorate.
Yeah.
But don't those two go hand in hand? Right? I mean,
yeah,
people losing their jobs,
right,
recessionary pressures.
Right. That's, you lose your job, you reduce demand. Reduction of demand brings down inflation.
Yeah.
Right. So they want higher unemployment. They just don't want it to the level that creates, a much deeper economic downturn.
Yeah.
And look, right now, nobody expects a recession. So again, just ignore this whole conversation because nobody expects a recession right now. Literally no one. No one expects a recession. So,
well, and that's I think is what's troubling, right? Because people do see the writing on the wall. We see the things that we all know about, the inverted yield curves, the leading economic index. We see more and more headlines of people being laid off. So I do think, in general, people are more cautious right now than historically. Even going back over the last, some odd couple years, people are becoming more and more cautious in this environment. So I do think that presents a whole other challenge. But like you mentioned, and like we've talked about many times, that when nobody expects something is usually when it occurs.
right.
And we're not saying that that's what's going to happen right now.
That's right.
But, you have to, this is why it's important to manage money, in a way that allows you to, take some chips off the table, add when necessary. I think but it also presents a lot more challenges.
Yeah, it does. So anyway, getting ready to wrap up the show. Michael Leibowitz's new article is on the website today. It's an interesting analysis on Toyota versus Tesla. And it's interesting because Toyota has been doing exceptionally well while Tesla is not. And he goes through a whole analysis on those two companies. So if you're interested in automobiles and Toyota versus Tesla, that's an interesting article he's got on the website today, realinvestmentadvice.com. In this weekend's newsletter, we're going to go through the whole bond analysis with this recent run-up in rates. We've been talking about how rates could get back to 4.25, 4.5, which would be our next buying opportunity for bonds, and we're getting there. So we'll kind of go through that analysis this weekend in the newsletter. So make sure you're subscribed at the website, realinvestmentadvice.com, and get the newsletter when it comes out this weekend. We'll email it to you. So anyway, have a great day. Happy Valentine's. Don't forget to do what you need to do. Have a great day. See you back here tomorrow.